Good morning everyone, this is Pandakwan and today I bring you a very big research that I'm calling the third wave. Why I do call it the third wave? Because Jensen has been trying to tell us that this is the next thing that they are thinking in terms of NVIDIA, chip infrastructures and whatnot. So what was wave 1? Wave 1 was semiconductors, where we saw like NVIDIA, ARM, AMD, all of the chip companies kind of exploded and people went and bought into those opportunities and that played out for them. Millionaires were made and then it became the infrastructure. Infrastructures was mostly the data centers that we are talking, and still it's a play like Iron, Nebius. There are so many other good companies which are over there. But once the infrastructure and the data centers, the power, networking, optical data capacity, once that is done, what is the third wave? Third wave is what we call physical AI. The AI components or the companies which are sitting at your home provides autonomy. One way I would say is the robots, like Tesla is making one of the robots, the autonomy, which actually helps inside the home. Right now, if you want to do something, you can see like as a human race what we are trying to do, but I won't talk much about that. But let's go into why Jensen say that. So the Jensen thread, why I'm calling it, because NVIDIA has spent the last year reframing its story around physical AI. Most of the call that I went into and listened, they were talking about robotics and autonomy as the next compute frontier. In 2030, we are going to the moon, having all that infrastructure that requires robots and machines first. Two of these names sit directly inside the orbit. So one is SERV Robotics, the other one is Aeva, which integrates right now with the NVIDIA stack. And the third one, which is the most important one, is OUST, which is also called OUST. So every robot needs to perceive before it can act. So what are the eyes, legs and depth? So these are the three pieces that will help you make money. So let me tell you more about OUST. So OUST is a LiDAR sensor stock. Quarter 1 26 revenue $48.6 million. Year-on-year growth, which is 50%, and that's just getting started. Gross margin 43%, cash $80.5 million. And if you look into all of the components which is happening, like if there is a mop and vacuum bot also in your home that uses LiDAR technology, and LiDAR technology is growing because now no one wants to use handheld vacuums or like a mop to kind of go and you are doing the work for yourself. There should be a bot which should already does that. So why OUST is the most de-risked? Because they have a lot of cash. Their EBITDA is also kind of decreasing, which is 6.9 million. The market itself is saying that sensing and perception of physical AI is this company. So they have also acquired Studio Labs. Studio Labs is one of the OS platform because they are improving their software stack. The demand, if you can look into all of the companies, Walmart, Amazon, all these big, they are already running industrial robots and warehouses, and there are so many warehouse automation which is still happening, like BJ's, HEB, there are so many other brands. Quarter 2 guide of 50 million to 52.5 million, that what they have said, which implies that the momentum is still holding and there is a clear path where management will increase their guidance for profitability. So that's like a major catalyst. And what is the preferred playbook? I will give you, like, you can have a long dated call spreads or a long calls. Long calls sometimes won't help you, but the spreads kind of beat the naked calls. That's what I am saying. But most of the things, like the example structure which you can see, is 60 to 80% is common stock, and 20 to 40% is a 12-month to 18-month call spread. That's what I will say. And then I have also looked into the positioning of institutional spreads. I've seen so many institutional spreads buying into OUST right now. Their demand is increasing for institutions and retail buyers. Another one, but a little bit risky one, is SERV Robotics. SERV Robotics, it's a violent company. They have 3 million in revenue, but year-on-year growth is 578%. They have 2,000 robots, liquidity 200 million. This looks great, but NVIDIA bought into it, but also sold some of the shares. So that's a little risk that you are taking. Revenue is accelerating violently, and they have been 7x a year, 3.4x sequentially, and also like NVIDIA is backing. But what you feel is that roughly their revenue is comparatively very less. That's one of the thing, but they are still integrating in China consumers. They have the best in robotics components, and they are building a lot. So SERV kind of needs to have a competitive edge over them in case they want to replace the Chinese bots. So a dilution is also a thing. Most of the times when these companies are not profitable and they are losing money at a very large pace, they can dilute their shareholders. When dilution happens, imagine there are 100 shares, now there are 200. So all the investors get frustrated. Whatever limited holding they were having, they have been diluted to 200. So the value drops, like it can be 20%, 15%, no one knows, but it will be across the shares. So that's there. Again, this is something that you can take a risk on. Sometimes you look at the charts and try to figure out what the line is, but this is also a very big component. And the biggest catalyst is President Trump has said that all of the chips which are going into China from NVIDIA or AMD, those should be banned. Even the companies which are outside China and are Chinese, they cannot buy it. So that's the bigger catalyst. You can see this skyrocketing within this month. The third one, and a very important one, Aeva. This is the depth. So when you're talking about LiDAR, you're talking about LiDAR-on-chip. So Aeva has made out the best technology, the longest fuse, which is basically their LiDAR-on-chips, measures velocity and position simultaneously. Let's say there are two bots they want to see and they don't want to collide. That's where their chip kind of comes in. They can sense each other out. And they have a revenue which is 6.3 million. The year-on-year growth is also good, which is 90%. Liquidity is also nice. Quarterly burn is 28 million, which is concerning. But again, the risk at the early stage that you are taking, that is the thing. And they have like liquidity, they have capital. So like, I would say there is a bull case definitely over there. You have to look into this. NVIDIA kind of integrates with them, and that is why I'm calling it a buy. I saw the institutional positions and holdings. So this is where like a lot of folks are missing. These three stocks that I told you is a part of physical AI. So all of them works on the same theme, three different risk styles. And you can see like all of them have been compared. One is digital LiDAR, another one is autonomous delivery fleet, and the fourth one is the LiDAR-on-chip. And these are all things that you can see. So the best position is OUST, the second one would be Aeva, and the third one would be SERV. So that's why you should size it accordingly, take risk accordingly. Thanks, and please follow my channel. I am Pandak Huang, and I give daily updates on these stocks. Thank you and have a great day.